Steve Malakowsky. Steve is with Compeer Financial and has been involved in the pork industry for quite so many years now, helping producers, and he's going to speak to us today on the financial risk management tools for foreign animal diseases. Please help me in welcoming Steve Malakowsky.
Thank you, Tom. Is this, can everybody hear me? Good. I thought maybe the Alliance question there was directed right at me and I was going to come up right away, but Jeremy, thanks for covering that for me. I am, again, Steve Malakowsky. I work with Compeer Financial, been there 25 years. And over that time, we've seen the tremendous growth in the U.S. pork industry, as everybody's aware. One of the my other duties, I'm on the board of directors with Jeremy for the MPPC representing the Alliance group. So yeah, we are very aware we're involved, and as a lender, it reassures me trying to manage portfolio. We have about $3.2 billion in loan volume that we manage in the swine industry alone. To see these two gentlemen here that presented in front of me, Dr. Holt and Dr. Pittman, on what they're doing and attempting to do in the U.S. industry to help provide some really risk management. And that's what I'm going to speak about here, as well as risk management in the industry, because it's it would be easy if there was a magic bullet out there, or silver bullet out there, but right now, today, it doesn't exist. And I know, Jeremy, you took the question with regards to insurance as well. That is one of the topics that I was going to cover here. I didn't have a slide in here, but I'll cover it right away, is what we had the task last week. We're in D.C. and talking to our representatives, and I would urge everybody to do the same when the Farm Bill is coming up, to try to get the point across that we do need some risk management tools in the event foreign animal disease does hit the U.S., ASFs in this case. There's an ask, or there has been an ask for funding for a subsidized insurance program for swine producers. So we need to keep pushing the envelope there to try to get some tools that the swine industry does need to help combat ASF. The other one was that we'd asked for is also to fully fund the vaccine banks. Right now, foreign animal disease, foot and mouth, was funded partially, but if ASF, we come up with a vaccine, that should be funded and held in a vaccine bank as well. That, along with the other ask for Congress, was to fund more beagles, the Beagle Brigade, make sure we can keep ASF out of the U.S., and fund the training labs in Atlanta as well. So there is some work, there's a lot of work being done on your behalf by the MPPC and the Pork Board with these programs that they're putting together. Because right now, you'll see from a risk management standpoint, or tools, there's not a lot of tools in the tool chest today for the financial side of things. Just want to comment on the team that I work with. We have Mark Ray, Nick Rui, Chris Murphy, Daryl Timmerman, and Dustin Compart. The group's been together several years experience. Like I said, myself 25, Mark's 38 years, and Dusty's the low man on the totem pole as far as experience, and he has 8 years experience already, so a very experienced group that I get to work with. These are the analysts that we work with on a daily basis. They look at all the numbers and analyze all the financials that come across the table, including production of the records. So the agenda today, management tools for FADs. Then I have a Compeer Financial swine database that I'm going to tie into some worst case scenarios here with regards to the industry if ASF were to hit, and what type of liquidity we would have in the industry in the event that we were to have that disaster happen upon us, and then get into questions. The first slide that I want to cover here, it is one of the tools that we have today. It is a subsidized program. It's LRP, a Livestock Risk Protection Program. And it is federally subsidized, and it's really a put option. So if you think about using a put option for your operation. It is a good tool, probably better used in your risk management, nearby risk management tool for your operation to lock in or put in a floor, so to speak, on your price protection for your hogs that you're going to sell. It would be a little bit expensive if you went too far out into the future to use this really as a tool for risk management on ASF, but it does provide some floor protection for you in the event that you were prices did crash. So coverage prices range from 70 to 100% of the expected ending value. So you do have that tool available. And at the end of the insurance period is one, the length of the coverage is available for a specific period, so you have to fall within that time frame. It isn't like you can just take coverage over 6 months worth of production and put it in one time frame like you can with futures or options. So you have to be very specific with this program. You can see unborn swine 30 to 52 weeks. All other hogs are 13, 17, 21 weeks, 26 or 30 weeks. And cost on this would typically run $2 to $5 per hundredweight. So it's not a cheap program. I mean, if you want to go with 100% coverage and a little bit farther out, you might be spending $10 a head or more on that program. So it can be rather expensive. One of the advantages, it does, like I said, it does put in your floor price, so you don't have to worry about price fluctuations or the bottom falling out on you. Insures against a decrease in selling price, enabling producers benefit from an increase in prices. So you can put that floor in. If prices go up, you still get the benefit of the higher prices. It is subsidized, as I mentioned before, and premiums are due at the end of the period. So you can go ahead and put the coverage in, and then you don't have to pay the premium until it's due at the end of the selling period. And it uses your area pricing to determine indemnity back to the producer. So the key to that is you can have your own contract and receive whatever you negotiate with the packer to deliver pigs. You can still utilize this program, and it has no bearing on what you receive from an income standpoint. It allows coverage for a wide variety of livestock, including swine, but it also cattle and dairy has a similar program as well. And ability to market livestock up to 60 days prior to end of the insurance period. Now, the one thing this does not have is the flexibility of options or futures, where you can manage that risk a little bit better. For example, if you have a futures contract on corn and corn price drops substantially, you may want to roll out of that futures position into an option position at that time and take some of the money off the table. It might cost a little bit more to get into that option, but you can protect that upside again with an option and like I said, take some of the money off the table and cheapen up your corn cost. LRP advantages continued here. It protects against a drop in market value. Ending values are calculated from a price series of data from the USDA's market servicing report. And coverage is available for hogs that weigh in a weight range of 189 to 351 pounds live weight, so pretty heavy hogs there as well. And there is an option to cover unborn pigs. You can have up to 750,000 pigs on this program annually. And that program period runs from July 1st to June 30th. So the important thing to remember here is if you're fully loaded on the back end of that program, you can load yourself up on the front end of the program again, and potentially, theoretically, you could cover 1.5 million head of hogs. So it does have they've expanded the program. I believe the limit before was about 75,000 head. They greatly expanded the program to help producers. The next program, and this is another government program as well, Livestock Gross Margin Program. And what this does is it doesn't have as much flexibility, but if you do not like margin calls in your operation, which we have several producers that are okay with margin calls, but we have some that do not like margin calls at all, this would be a program that could be tailor-made for them. It covers the cost of corn, soybean meal, and hogs, and you just lock down a margin, and that margin is calculated at the end of the period as well. Insurance periods run for 6 months. There is no limit with regards to the number of head you can have on the program, so you can choose locking down all your pigs for the year if you would like. And then choose a deductible, $0 to $20 deductible. Obviously, if you don't have any deductible at all, your cost in this is going to be rather expensive as well. And that's people on the hog side of the world have shied away from this program a little bit just because of the cost as well, because you can get into that $10 plus per head cost as well. So a lot of times, and you'll see later on here what I'm talking about when we get into the database, a lot of times there isn't $10 a head margin in the U.S. hog industry. So it makes it difficult to spend everything just on risk management. Other risk management tools, and this slide here is what I would say 95% of the operations that I work with and our team works with use today. They do use LRP. I'll roll that into here, but future price contracts, but you need delivery on the future price contracts. And if ASF were to hit and you're in an affected zone, you can't deliver pigs, so there's no coverage there with the future delivery contracts to a packer. Future contract sales provide coverage but not tied to delivery. Again, from a risk management standpoint, it's a good risk management tool for your operation, but the cost of that could be rather high long term and not an insurance product either. So it's more risk management for your operation. Out of the money put options, and this is the one that we're seeing more traction on by numerous producers that we work with today. So out of money put options, you can spend anywhere from 20 cents to 50 cents per carcass hundredweight. And that would be a typical program utilized either the summer months or October. You can go ahead and, when markets are a little bit higher, target a very out-of-the-money put option. Let's say on this example here, I have 60 cents or $60 hogs. And so you could assume that if the markets were to drop, that if you had ASF were to hit the U.S. and we lost 50% of the value overnight in our markets, which I believe we will, it would take a little bit because we'd just be limit down until we bottomed out, and it's going to be at least 50 cents on the dollar. You'd have a targeted gain of $30 in this scenario. So with this example, if you have a $400 lean hog contract, take out 1,000 contracts of options, you put in a $60 floor, at the cost of that would be 25 cents. So for $100,000 coverage on your operation, it'd be about 80,000 head of hogs, you would have $12 million of coverage for your operation. Now this is all a synthetic out of the money put option. So are you willing to spend 50 cents a hundredweight, 25 to 50 cents, in this case 25 cents, to put an option strategy in place that is long-term just for ASF? Everything I'm seeing and what I would recommend, if you're going to use this strategy, use this outside of your risk management plan that you're utilizing today. So this is in addition. So we talked about an insurance program subsidized by the U.S. government in the event that there's ASF or a foreign animal disease in the U.S. This can accomplish the same thing for a short period of time. So maybe 6 months, you can continue to roll 6 months out at a time. Now the key is, and you'll see some of the numbers later here, is if ASF hits into the U.S., we have 30% too much production today So we're going to have to greatly reduce production. Now, part of that would be some of the imports that we're bringing in from Canada, but from a production standpoint, I would say probably at least 25% too many sows today. So it's harsh to say, but if we go down that path, we're going to have 25% of our producers out of business. And that's going to affect everybody in this room. It's going to affect producers, alliance members, everybody, to the tune of 25% less sales in marketing animals and everything. So it'll be substantial. But whoever can survive that first 6 months to first 12 months, they should come out much better. I think we've seen it in China there, where the prices rebounded and they actually had substantially higher prices over a period of time because of the liquidation that they had in the industry. The other program, Lloyd's of London, about $1 a head. They came out with a program for PRRS. That didn't, they gained a little bit of traction there. There are a couple other insurance companies that tried it as well until, I'm not sure if they had it calculated right with the amount of risk that was involved with PRRS. They made some payouts of those. Some of those companies just went away after they really learned what PRRS was all about. So I haven't heard of anybody from Lloyd's doing this on ASF, but it would be an option. I know you could go there and get a policy, but it just depends on what it would cost. And I'm not sure if you could get it for $1 a head today. And another option is to buy out-of-the-money puts close to the market. So continually within the next 2 to 3 months, be up to just have additional puts in place in the event that the market were to tank. That could be very costly as well, especially just for an ASF insurance program over and above what your risk management protocol is already. So I tie this into the database that we have. This is a disclaimer that basically states that I'm not going to warranty any information out of here. We get this from producers, and so don't hold it against me. The database spans across the U.S. It's about 20% of the U.S. industry and sales to all processors, and I have information from 2017 to 2022 at the quarter end, second quarter end for this database. And I like the second quarter the best out of every quarter that we do, just because it takes out of all the quarters that we have, it seems like we have some other influence on the numbers. Year end will be a lot of tax planning. And the first quarter coming out of that, we may not see all the effects of tax planning and prepaids out of there yet. Second quarter, it seems like we've flushed out all the tax planning in there. Third quarter is pretty good too, but I really rely heavily on the second quarter information. You can see in 2022 we had a substantial gain in equity, 5% from 2021. That's due to the earnings that we had in 2021, and continued earnings in 2022 here. So we've had a pretty good run of about 18 months coming out of COVID when everything fell apart. Fixed debt per sow, you can see it's $1,472 per sow. And above that is working capital per sow, $1,247, up from $1,039. And out of all the numbers here, that's probably the one you want to focus on the most, because that will give you, and I'm going to use that number later here as an example, that'll show your longevity in the swine industry. Our target and covenants that we will have on operations is somewhere around that $600 per sow. I would say a floor would be $400. If you get below $400, you have an operation that's probably in pretty rough shape. So you can see from a liquidity standpoint, a good target for owner equity would be 50%, $600 on working capital, so well in excess for both those targets. And fixed debt per sow, you can just see the increase there was gaining or improving liquidity in your operation. So I think as we're As we move down the path here, and we haven't seen a lot of growth in this industry over the last 18 months to 2 years, we're seeing operations where they're trying to improve liquidity in their operation in the event that some disaster does happen. So they're building the liquidity ahead of time. Operating debt per head marketed $43, and that surprises me that actually went down, especially since cost production has gone up quite a bit. So here's ASF impact, and as you recall, I talked about some of these scenarios earlier. So I got this information. Dermot Hayes presented this several years ago. It started back in 2011, and it was updated in March of 2022. Just a ASF impact, 2-year impact, would be $15 billion to the U.S. industry. So how do we bridge that gap? So in his analysis there, he said hog prices would decrease immediately 40 to 50%. I used just an example here. I had prices decline by 45%. I took the midpoint on, a couple days ago, September 16th, the average price for the next 12 months and futures prices was $96.24, so a pretty high average price for the next 12 months. And 45% decline would be, we'd end up at $53.23. If you have a 90-cent cost production, which everybody does according to our database, you'll see that on the next couple slides here, with a 215-pound carcass, you're going to lose $79 a head. I'm not sure about anybody's operations in here, but if you lose $79 a head, you're not going to be in business very long. That'll wipe you out instantly. So when you have working capital of $1,247, you market $25 or 25 pigs per sow marketed. And if you lost $80 a head, let's assume you have a put option gain going back to that scenario that I'd put in there. That would offset $64.50 of your loss. So your actual loss in that scenario, this is why they're carrying this insurance, or not insurance, but using this strategy to offset some potential losses in the future. They're willing to spend $1 a pig in order to put this protection in, and they have to keep rolling it every 6 months. So they would have an annualized loss of working capital of $375 per sow. So at the end of 1 year, they would end up with $872 versus the $1,247 that we were at earlier, but they would still be in business. Otherwise, you're going to absorb that full $80 per head loss immediately. So if we don't have the insurance program, this is really the only option that they have out there to put in a floor and make their own insurance product. This here just summarizes the profit and loss that we've had for 2022. Livestock revenue of $93.82 for the first 6 months of the year. Operational cost production, $89.55 with a profit of $4.93 per hundredweight. A hedge loss of $2.90. So consolidated profit and loss of $4.49. And you can see by the reports, but the carcass weight on our database would match what the USDA has. Pigs just keep getting heavier and heavier. They're 217-pound carcass. We also compare this to the Iowa State model. And the Iowa State model, for those that don't know in the room, it sells a hog and buys the corn and meal all the same day, so it's always on the open market. And we just use this to compare what our producers have done against the open market. And in typical high market periods like we're in today, Iowa State model would have an advantage where probably 80% of the time it seems like our producers will outperform the Iowa State model based on what their risk management plan is. So you can see here the difference of $2.76. Iowa State profit was higher than what our database shows as well. This is just a slide, a couple slides or graphs summing up the information that we had previously in some of the slide decks ahead of that. Cost production, revenue, both up substantially. Unfortunately, the costs have gone up along with it. Right now, we're seeing cost production, I would say average value on inventories in our portfolio is probably about $120 a head on per market animal. So this kind of tells us the story, and we watch this weekly in our office. Today we're at about almost a 40% advance rate. So if we have a $1 million operating loan out there, the average producer would have a $400,000 balance, and they would have $600,000 available to borrow on. Anytime you can see back in 2014 when the markets ran, we'll never get to 100%. Because every time the markets ran up, we would continue to do additional advances, and we'd put more liquidity in their businesses to cover their margin calls. But once we get beyond, if we're to push 50 or 60, 70%, things start getting extremely tight for our producers, because you have to remember, on 40% advance rate on average, it is a bell curve. So some producers are at that 40% advanced, some are at 0, and some may be at 80 or 85%. So with that, I'll take any questions.
Let's give Steve a round of applause. We've got a question in the back.
Yep, in the back there.
So in reference to some of your insurance options, they focused on producers that are selling, live pigs or whatnot. What insurance options would you recommend for like a third party that just owns or has ownership in a barn, no control over the hogs or marketing or anything like that? They're just like a contract barn owner, and that as far as, there's insurance policies for lack of income generation or things like that. But is there any policies that you would recommend as a lender? Like, let's say I was going to build a barn, you're financed it. What insurance policies are available to just a barn owner per se that has no marketing capability of live pigs, just owns the barn and rents it?
Yeah, boy, that's a very, very good question. Unfortunately, there is no insurance that exists today to cover that. I know as a lender, we're also looking at programs as well. How do we insure our portfolio? And to take the top end off the risk in the event that it happens and we're to lose a substantial amount of money as well. And there's nothing that exists today for either one of those scenarios. Just like for producers, you can synthetically create that option strategy. But to me, I think that's the importance of knowing if you're going to have a contract barn with a grower or owner, and understanding the strength of that owner of those pigs, and having a good discussion with them with regards to what are they doing in the event that ASF were to hit. Unfortunately, whether you're a packer or an owner or anybody, they probably all have a force majeure clause in their contract in the event of a tragic event, whether it's tornado, fire, or a foreign animal disease. I don't know. There is no simple answer for that. There's nothing that exists today. But it would be something great to bring up to continue to push towards your Congress men or women out there to bring into the Farm Bill.